The nice part about passive investing in real estate is the 27 deals that I'm personally invested into right now. We don't pay a dollar in taxes on any of those investments because every year we have enough depreciation loss activities to where we're able to use that paper loss, so to speak, to help offset the passive income gains that we've made through distributions and the equity profit split that we received at the end when some of those deals, and they do every year, there's a few deals that go full cycle.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Jeremy Dyer. Jeremy is the founder and managing partner of Starting Point Capital, where he leads the company's investor relations, strategic partnerships, and serves as the director of marketing. He is what I can only describe as a prolific passive investor, in addition to his active investing with Starting Point Capital. So I can't wait to dive into that. Jeremy, welcome to the show.
Yeah, Tim, thank you for having me.
Awesome. So I gave everyone a little preview of your background, but please get into the details on how you got started on your journey and tell us how you got to where you are today.
Yeah, great. Thank you for asking that question. My journey in terms of where I am now from a financial perspective really started very early. Even back in my high school, college age days, I always had a passion and a desire to sell. And so I've had several sales roles over the course of the last 2.5 decades. My previous and current employer, I've been fortunate enough to be able to really sell my way to the top in that organization. And that had afforded me to have some additional cash available on the sidelines, otherwise known as dry powder. And so I early on would try to find the next Amazon, Facebook, Apple, Tesla stock. Was able to fortunately max out on my 401k each year, invest in some angel investments along the way. My wife and I were blessed to be able to have our dream home paid off by the time I was 23 years of age. I had a 40-foot RV sitting in my driveway by the time I was 25. So all that to say, from a financial perspective and a grinding it out earnings W-2 perspective, things were really going well. And then I would say my wife and I got a little bit bored back in 2012. We decided that we wanted to get in the fix and flip business because that looked really sexy on the HGTV channels that we were watching at night before bed. Okay. So because we had additional dry powder sitting on the sidelines, we were able to really wrestle out and jockey out a lot of other potential buyers of some pretty dilapidated homes. Why? Because we were coming to the table with cash, no contingencies. And so we tried our hand at the fix and flip business on the active side. The challenge became in 2015 after we had fixed and flipped several properties and certainly had some challenges and issues along the way there. The greatest challenge that we had in 2015 is our priorities were not in alignment, because what happened in 2015 is that we also made the decision to double down on kids. So we went from 2 kids to 4 kids. My 2 older boys were really busy in all their various activities on sporting events. And it was becoming this environment in which dad was working a full-time day job. Mom was helping out with the fix and flip business. And we were spending evenings and weekends actively managing a real estate portfolio. And so it became a point in our journey where we had to make the decision, do we continue to actively be involved in real estate, or do we make that pivot to doing it passively? And so in 2015, we made the decision to exit the active real estate business and instead passively invest into a real estate syndication. And if you were to ask me back in 2015 what the word syndication meant, I wouldn't have even been able to tell you back then. Okay. Reason being is because I knew somebody that was in the business, a longtime friend. He got me interested in the investment opportunity. And I would tell you that I used the shotgun approach on that first deal that I invested into. And that shotgun approach was I held my breath and I plugged my nose. Okay. And then that wire transfer. Fortunately, 36 months later, that investment had doubled. We achieved the 2x equity multiple on our money. And from that point going forward, now I was completely hooked on the strategy of investing into real estate, just not doing it on the active side anymore, but rather doing it on the passive side. So now if you fast forward to today, 2023, almost 2024, hard to believe, but we are currently actively in 27 different investments as limited partners or passive investors. 80% of those investments are in the multifamily space, and the remaining 20 are in other asset classes like assisted living, self storage, retail, flex office, et cetera. And of those 27 investment offerings that we're in today, they are with six different investment sponsors.
Yeah, and there's a couple of different things that I want to hit on. First of all, your experience. I'm always amazed at the level of financial success that people can achieve in sales if they're really good at it. You talk to some people, and yeah, I had a couple years sales experience, went on to this, that, and the other. And there's other people that you talk to, and they were like, yeah, I was retired by 25 after. It's just so foreign to me that it's even possible to make that much money that early on in life, because my head was just not there, right? I went straight into the military after high school, and the last thing I knew is how to sell anyone anything. And it's such a valuable skill to have. And if you can hone that skill and become really good at it, and I think if you, especially if you do it early on, you build like that resilience to rejection, which can be beneficial in so many aspects of life, but especially the money that you can gain if you, like I said, if you're really good at sales early on, because let's face it, right? The more money you make early on, the better it's going to set you up for the future. And I think you're a perfect example of that, because you said, hey, yeah, you started doing the fix and flip because who wasn't when it was so hot on HGTV? Luckily, I avoided it, but I still watched the shows. And then you went to the passive investing, which is that more long-term focus. And that's what I think a lot of young people, I think, probably lack, is that long-term focus, myself included. I'm not taking myself out of that group. And so I think that's why like the fix and flip and stuff like that is so attractive, and why you don't see more young high earners getting into passive investing. Is that kind of your feeling on it?
Yeah, it totally is. And I'm glad that you brought up that point. I think the fix and flip business and actively managing a single family portfolio, I think that's for the young kids. Okay. When I say young kids, I'm referring to people that are maybe in their 20s and 30s, but it's really difficult to actively manage a real estate portfolio or manage a fix and flip business while at the same time having a full time day job where you're grinding it out every day. You're becoming a better version of yourself. You've got roles and responsibilities, and then you've got children alongside you as well. That one day you hope not to wake up and say, wow, my kids are out of the house now and I barely know them because I've been too busy managing my active day job in combination with this side hustle, otherwise known as a real estate portfolio. So I think that's a really great point. My encouragement to the younger audience really is to really focus in on your day job, crush your day job,
Mhm.
manage your expenses well. And when it comes to investing, whether that's investing in Wall Street or Main Street, right? You've just got to get to the point where you get started. You're going to make mistakes along the way. I made mistakes. Okay. I used to day trade stocks when I was in college, and I just got absolutely burned, right? Burned to the point where I was even using my college tuition to day trade stocks, and I was doing it on margin. So when stocks would go down, those losses were just amplified. We all have warts. We all have stories like that. But at the end of the day, when it comes to investing, making wise investment decisions that have been de risked, partnering with people like Tim and myself to learn about what some of those are alternative investment strategies are that maybe exist outside of Wall Street, is really going to be your best bet, especially when you get to the point where maybe you've got one kid, two kids, or four kids like we do, but you just have to eventually pivot more towards the passive side of investing and not doing it on the active side.
Yeah, I think that's such great advice. Like you said, the crushing it in your day job, try to make as much money early on as you possibly can. One, because like you said, it sets you up well for later, but then it also just gives you the opportunity to invest for the long term. And I think like, again, we don't think about this as often, but I think the other piece of it is the living below your means while you're still young. Like I know all I was concerned about was having fun when I was in college. And I was not exactly pinching my pennies. If anything, I was probably borrowing for school. And a lot of that money was not going to school, it was going to alcohol. And I'm not proud of that. And I think about if I would have saved more money back then, because that's what I reverted to later, right? Once I had a job and I was living below my means while everyone else was getting brand new cars and houses that were way too big for them. I was living a level below that, not a hermit or anything, but just within my means. That way, it allowed me to save more of my income, which again, you could put to maxing out your 401k, just like you talked about, or saving up for something else, or even kids, right? Once that comes along, that changes the entire calculation for everyone that I know, anyways. And that's why one of the things that you said really resonated with me, which was the when you doubled down on the kids, it went from 2 to 4, the cost of that time in your business became too high, right? And you weren't willing to pay that price. And so you were looking for a way out of, like, flipping, for example, is a very intensive way to make money in real estate. And a lot of people don't realize that until they start doing it. But even me, I had a triplex that I was self-managing because it was close enough that I could do that. And I was like, I'll save 10% from paying a property manager. I don't need them. And so I was working full time as well. So it became after work, on weekends. I'm dragging my 3-year-old daughter to this apartment to go fix something, but also try to show her. And it was just taking up so much of my time that I was like, you know what, that 10% isn't worth it. And what am I doing? Right. I'm really glad that you mentioned that as well.
Yeah, absolutely.
All right. So a couple of other things that you talked about, the transition to passive investing. I think it's interesting because sometimes what I more often see is people start off as passive investors because that's like the first time they discover real estate. And then they move into active investing. And then they say, eventually, I don't want to do this anymore. And they retire, right? But your journey has been a bit different. You were active in the sense that you were fixing and flipping. And did you do any like deals as a general partner before you passively invested? Or what was the timeline there?
Yeah, great question. So the answer is no. So I was never in partnership with anybody. So no joint venture deals. I was never the general partner of a real estate syndication. All of the experience that I had up until the point that I took the plunge into passive real estate investing was really all on the single family side. Okay. And really, again, that decision was primarily made as a direct result of me needing to have more margin in my life, me desiring to have more time freedom. So I had the freedom that I, wanted and the bandwidth that I needed in order to spend time coaching kids hockey games and practices and going to my daughter's figure skating competitions, spending time with my family versus continuing to spend more time away from them.
Yeah, so we talked about some of your motivations for getting more involved in passive investing. What are you hearing from your investors in terms of what's motivating them to come into passive investing? And really, what problems are they trying to solve? And how do your investment opportunities help them do that?
Yeah, that's a great question, Tim. I would say there's a few different reasons why investors make the decision to invest into our passive real estate investment opportunities. One is maybe they're an active investor, maybe they have a single family portfolio that they're managing, maybe they're themselves doing a bit of fix and flip on the side as a side hustle, and they're just tired. They still want to be in real estate, but they just don't want to be swinging hammers on evenings and weekends, so to speak. The other type of investor is that individual that's really looking to diversify outside of Wall Street and what I call into Main Street. So it's that investor that maybe maxes out their 401k every year. Maybe they contribute to their, each calendar year. Maybe they're trying to find the next Tesla, Amazon, Facebook stock and kind of ride it to the moon thing. Or maybe they're investing in cryptocurrencies and other alternative investment opportunities, and they want to diversify. So the moral of the story is for that investor is they want to diversify outside of Wall Street and into Main Street. It's not that they're looking to kick Wall Street aside. It's just they want to be able to provide somewhat of a hedge against the downward propensity of Wall Street oftentimes, and they really want to escape that roller coaster. We also have a number of investors that are really seeking cash flow, right? They appreciate some of the investment opportunities that we bring to our investors where they can regularly receive cash flow through those investments that are tax advantaged. And obviously, when I say tax advantaged, it's through the depreciation side of the investment opportunities that we bring, where investors reap the rewards of that depreciation loss activity, which obviously helps offset some of that cash flow that they receive on the investments during the.
Yeah, so there's a couple of things I heard you say there. One is just diversification, right? And I think that's a really important point because if you listen to CNBC or Bloomberg or any of those, you would think there is nothing else to invest in other than the stock market. And so it's really frustrating that a lot of people just aren't aware of it. And that's why I enjoy doing this, right? Just to open their eyes up to other options. And there's certainly, benefits and drawbacks to different investment types. I think we can all accept. That's why I'm not an all or nothing, kind of guy. It's not just stocks and it's not just multifamily or real estate in general, because each has their own benefits. Stocks, you have the benefit of high level of liquidity, right? You could sell it within seconds if you want, and some people do. But with real estate, you have other advantages, like you talked about, which I think is important. They are very tax advantaged. You have depreciation, accelerated bonus depreciation, all these different types of depreciation that you can use to offset some of your gains that you just don't find on Wall Street. So I think that's a really important point too. And especially with high income earners, I think the distinction, sometimes we in the field, I hear people oversell that aspect of it. They're like, oh, are you a high income earner? I've got a deal for you. You can invest in real estate and you'll be able to write down all these taxes. You'll be able to offset investment income. And I think and it's not a big deal. It's just, we have to be very transparent with that, hey, you cannot write down your W-2 income with the depreciation that we offer through something like a K-1, which is just the tax form that says, hey, this is how much depreciation you got on this thing that you invested in. But how I put it into perspective for a lot of passive investors, I say, well, think about it this way. You might get enough depreciation, from this investment that it completely writes off any of the cash flow that you just talked about, the cash flow from that investment. So you essentially just got tax-free profit. That's pretty good, right? So that's one of the ways that I try to put it into perspective for people, because especially when the only frame of reference that they have is stocks, their 401k and Roth IRA and all these things, they're not used to looking at it that way, is what I found anyways.
Yeah, it's a good point. And it would be great if I could receive some form of a tax benefit on maybe stocks that I purchased 20 years ago and I'm sitting on a 200% gain. But the reality is I'm going to have to pay taxes on those gains. And that's the nice part about passive investing in real estate is the 27 deals that I'm personally invested into right now, we don't pay a dollar in taxes on any of those investments because every year we have enough depreciation loss activities to where we're able to use that paper loss, so to speak, to help offset the passive income gains that we've made through distributions and the equity profit split that we receive at the end when some of those deals, and they do every year, there's a few deals that go full cycle.
Yeah, and I think that's the difference between doing taxes and having a tax strategy, which took a little time for me to learn too. I thought about it before as very black and white until I started to realize, oh, when I sell this duplex, that's a huge taxable event, right? I also passively invested in this real estate deal that is going to give me this much of depreciation, which is actually going to offset that taxable event that I had. And so it becomes part of this larger strategy, not just like a one-off thing. So people need to remember that too. And having a good CPA can make a huge difference, especially as you get more of these investments and they become more complicated.
That's right.
I think another thing that I wanted to mention, you talked about how people can't just do this in their retirement accounts. And one thing that I'm always preaching is self-directed IRAs, because I find it's a way that people have more money to invest than they thought. And it gives them control as well, which they lacked before. And for those that don't understand what I'm talking about, basically, so many of us have hopped from job to job, right? Especially recently. My wife now doesn't stay at a job more than 2 years because that's just the average term. And so when you leave these jobs, you often have a 401k with that employer. And once you leave that employer, it's just sitting there. I call it orphaned, right? It's just alone and afraid. And it'll continue to do its thing in whatever it was invested in, but that may not be the best use of those funds. And what I always tell people is, hey, you have other options. And that's what I like to present, options. You can put it into a self-directed IRA, and then you literally could have checkbook control over that money to invest it in things like passive real estate opportunities like the ones that you and I offer. Now, you don't get those tax benefits that we talked about, but that's fine because it's already a tax advantaged account. You don't need depreciation. So that's another thing that I really like to tell people, because a lot of them just don't know. And again, those 401ks are often just sitting there neglected. And you really empower people when you say, hey, you don't just have to put it in fund A, B, and C that your old company offered you back then. Now you could put it in virtually anything that qualifies. Of course, there's always qualifications. So
Yeah.
I don't know if that's something that you talk to investors about too, or if you have a lot of folks that invest with you from self-directed IRAs.
Yeah, we absolutely do. And obviously, the story is very much the same as the picture that you've painted here, where people feel like they're setting that money free. It was shackled before, can't touch it until they're 59 and a half. But now they actually have access to some of these funds that they can get into the real estate investing game or strategy without even coming to the table with liquid cash. So they're able to your point, they're able to take some old IRA money or old 401k money and roll it into a self-directed IRA. And through that strategy, they're able to deploy some or all of that capital into our passive real estate investment opportunities. So it's a wonderful strategy for people to consider. I can tell you just this week alone, I've gotten 2 phone calls from people that want to deploy that strategy. Potential investor number one said that their average annual return over a 5-year period in their IRA was 7. Passive investor potential number two told me that their average annual return in the last 5 years was 4%. Okay. We all know where inflation has gone in the last 2 years. So correct me if I'm wrong, but I would say that both of those investors are more than likely upside down, meaning they've lost a significant amount of purchasing power over the course of the last 5 years on their investments because their investments have not exceeded the inflationary rates.
Yeah, absolutely. And we could talk about potential returns for real estate, but it far exceeds the numbers that you were just talking about. So I think that's the other important thing too. People don't understand how quickly these numbers can compound. In my personal experience, I invested with a solo 401k that was a rolled over TSP from a previous employer. And I doubled that money in, it was less than 3 years. Now, this was during COVID, so that's black swan event, right? May not ever happen again. But still, it just goes to show the potential. Even if the next deal that I more recently invested in about a year ago, even if it takes 5 years for that money to double, I'm okay with that. That is still great returns, especially compared to the numbers that you were just talking about.
That's right.
Yeah. And so now I want to go into your experience as a passive investor, because I think it's just a case study in the potential that's there, right? And potential that one day I would like to capitalize on and become as prolific as yourself. So talk to me about, how that has, like, I guess, compounded. Because I imagine that with, every investment that has, matured, deal gone full cycle, I imagine most of the time you probably reinvest that money. And then you could talk about maybe the different strategies with putting that money to work. How you talked a little bit about the diversification within your passive portfolio, which I also think is important. So please expand on that a little bit.
Yeah, I'd be happy to. So I'm a real big fan of not putting all of your dollars into one basket, so to speak. And so I would never encourage another investor to take all of the liquid cash they have sitting on the sidelines and to deploy it into one of our investment offerings, or for that matter, self-direct all of their old IRA or 401k money into one deal. Okay. I'm a huge fan of diversification, not only of sponsor, but also asset class. Obviously, location in which that asset is located in are all good strategies. So the 27 investment opportunities that I'm currently invested into, that's 6 different sponsors. It's probably 10 different states, right? It's 5 different asset classes. So I'm a big fan of obviously diversifying in that stance. But now that I've been investing since 2015, I've had deals go full cycle. I have deals that are paying regular, consistent monthly and quarter that are paying commissions. My own strategy is to take first of every month, have it all go into one account. And then once that account balance reaches, the minimum level for the next investment opportunity, I just redeploy that cash into the next deal. Okay. When I have an existing deal that I'm invested in deal, okay. When I have an existing deal exchange strategy or a lazy delay, the tax consequence on the profit that I receive when that deal goes full cycle. So I'm very much a big fan of redeploying that capital. It's a rinse and repeat effort. It's the seventh wonder of the world, and that's this word called compounding. And it's amazing what happens. It's amazing what happens if somebody just makes the decision to get started today investing passively as a real estate investor. It's amazing what can happen in just a 5 to 10 year period. Okay. This is not a get rich quick scheme. Okay. People don't get rich in real estate overnight. People get rich over time, but not overnight. And so you always have to have this long game mentality. You have to determine what is your end goal and then reverse engineer what the strategy is that you need to deploy to get there.
Yeah, I couldn't agree more. And I think it's a really important point. And I would say this goes for both passive investors and for active investors. A lot of active investors get in thinking that they're going to replace their income within 1 year. And it's no, bro, that's not how this works. And sometimes you just buy into the hype at first, right? And I get it. And there are fees and stuff that you can get as a general partner. But in reality, it takes time also. And the reason is because the timelines associated with most of these deals is between 3 and 5 years. And I think we're seeing with the current market, that's extending out to now probably 5 or 7. And so if you take that into account, just like you said, the earlier you get started, and it took me a little while to understand this. Okay, if I get started now and I do one deal this year and say one deal next year and maybe two deals the year after that, what you're doing is you're building this pipeline, right? And so you may not see a ton in between, right? You may get some distributions, and that's great. The bigger your investment, obviously, the bigger the distribution is going to be. But hey, maybe distributions are slowing down right now because multifamily is facing some headwinds. That's okay, because you still got to look at the long-term picture. But, at year 4, when your first deal goes full cycle, you collect a big chunk there. And then, oh, there's that second deal that you invested in. It matures at year 5. And then all of a sudden you have this boom. You've built that pipeline that now never stops as long as you start and keep doing it.
Yeah, absolutely. And once you get started, you're right, you can't stop. So it's very difficult to get out of real estate once you've gotten into it. And it is the strategy that the very wealthiest of wealthy people use. But once you're invested into real estate, it's very difficult to get out of it because you need to continue to find a place to put those dollars into the next tax advantaged investment, right? But most people that get invested into real estate, they never want to get out because of opportunity cost of where else am I going to put that money and get similar returns that are really risk adjusted.
Yeah, absolutely. Could agree more. We do need to transition to the turbo round. So I am going to ask you 3 questions that I ask every guest that I have on the show, and I just ask you for a quick, honest answer. You ready to go?
Ready to go.
All right. First question. What is one red flag every investor should look out for?
It's tough to come up with one because I could probably come up with 12 of them, but I'm going to pick one. And that is oftentimes investors like to just go straight to the deal deck. They like to compare investment A against investment B. And when they compare those two different investment opportunities against one another, they tend to go towards the internal rate of return and the equity multiple. And oftentimes they might look at the equity multiple on deal A and it says it's a 3x equity multiple. And then they look at deal B and deal B is presenting a projected 2x equity multiple. So of course they're going to go with A because the equity multiple is larger, right? The challenge with that thinking is investment number A has a 10-year projected hold and investment B has a 3 to 5 year projected hold, right? A 2x equity multiple over a 3 to 5 year hold is not the same thing as a 3x equity multiple over a 10-year hold. So I would just encourage investors to be savvy in terms of what some of those projections are. And obviously the biggest thing is stress testing the assumptions that the sponsor is using in their investment presentation. There's a lot of very simple assumptions that investors can take a look at and say, does this smell right? Are they really going to be able to burn off that much loss to lease as an example? Are they really going to be able to implement a value add strategy and increase rents by $500 per unit? Well, those are some very simple questions that, investors that aren't in the space can really be asking themselves to determine what type of investment are they willing to put their hard-earned money into.
Yeah, that's a great point. And I think a lot of sponsors now are starting to just head those questions off at the pass, right? And put in a stress test slide, right? We've already told you what our assumptions are. Now here's a stress test to show, hey, worst case scenario, say we don't meet this rent bump every year. What if it's only this? What if the cap rate is this instead of that? That way you can show, even if there is a downturn or whatever the case may be, the deal still performs, maybe just not at the level that they're projecting. And it just shows that you're thinking through it a little more conservatively and thinking about, I don't want to say the worst case scenario, but maybe it's the worst case scenario. Really good point there. All right. What is a myth about this business that you would like to set straight?
Yeah, I already mentioned it before, so I'll say it again. And that is investing passively into real estate is not a get-rich-quick scheme, okay? It's not going to replace your active income, your W-2 income overnight. Okay. That's not what's going to happen here, right? Could it drastically offset your active income over a 5 to 10 year period? Absolutely. Okay. But it's not going to happen overnight. And the reason for that is because while you can day trade stocks, you cannot day trade apartment buildings.
So true. All right. Final question. What does success look like to you, Jeremy?
Yeah, I think about this question a lot, right? I would say that the most important, or one of the most important factors of success for me is really what I like to refer to as time freedom, right? We all only have a certain amount of time that we're going to live our lives, okay? We can all manufacture more money, we can manufacture more things, okay? But what we cannot manufacture is more time, right? And so that's really the only, asset that we have that we can't create more of. But if I can make investment decisions today that allow me to be able to have more time freedom tomorrow and into the future, that is really at the heart of why I'm investing into cash flowing assets, come with all the great benefits of depreciation and diversification and all those things, and the equity upside that I get is really so that I can have more time in my life. It's not because I want to become rich, it's because I want to be able to have more discretionary time to spend the time on the things that I want to spend time on and with the people that I want to spend it with.
Absolutely. All right. Hey, Jeremy, this has been awesome. Really appreciate your insights, especially when it comes to passive investing with the amazing amount of experience that you have there. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, no, great. And Tim, I really appreciate you having me on the show today. I'm relatively active out on LinkedIn. You can find me there under Jeremy Dyer. I also host a podcast by the name of The Freedom Point. And you can also learn more about our company at startingpointcapital.com. Again, that's startingpointcapital.com.
Yeah, I hear you have some amazing guests on that podcast, by the way. And don't worry, we'll have all that contact information in the show notes. Again, I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.